Let's get a big picture discussion going here. We got some time until the bell. Liz Ann Sonders joins me alongside Cooper Howard as markets are right now Liz Ann joining us to talk some stocks. Cooper's on bonds, of course. So Liz Ann, get us started here as we've got an inflation print tomorrow. Right now, how much do you think the stock market can tolerate in terms of surprise?
I think it could tolerate a surprise on the downside, but less so a surprise on the upside, especially on a day like today where you have oil prices up by about $1 and yields have ticked higher. So, CPI, both CPI and PPI historically can have bigger moves above or below consensus estimates. It's a little bit more of a wild card. It tends to be a mixed bag month to month in terms of whether you get an upside surprise or downside surprise. Same with PPI. You don't tend to get as much of a move around consensus. The release of PCE tends to be closer to consensus because of the fact that the data you have in CPI and in PPI can be mapped to PCE. So CPI and PPI have had the tendency to be more market moving than the Fed's preferred measure. So we'll see.
Love that point. One that you've reminded us before, and I think it's a really important one. The timing at which things come out. That's where our conversation with KG, the technicals kind of seem lined up for potentially a fun move for the short-term folks. Bonds maybe warming up a little bit here, Cooper. Some selling the last couple of days, but I know we had a nice rally. How are you looking at that chart?
You know, we have seen a little bit of a move up, but over the long term, like you said, about the past month or so, we have seen yields pull back. I think there could possibly be a little bit more upside in terms of yields from here, Oliver. Kind of what our team has been looking at is if you take the culmination of a lot of the policies that have been proposed in Washington or that are potentially coming out in terms of Washington, they do have a little bit of an inflationary bent. So if you look at things like trade, immigration policy, tax policy, all of those taken in culmination have a little bit of that inflationary side to it. So we could see yields move up a little bit higher over the longer term. Now, in terms of the short term, like Liz Ann mentioned, I think that the market's going to be closely watching what CPI comes in at tomorrow, as well as PPI later on this week. If we see a little bit softer of a print on CPI, a little bit lower, then I would expect that we might see yields move a little bit down in the short term. So it's also going to be a factor as far as what the Fed does later upon this year.
How about the curve shape, Cooper? Give me a thought on that as 10s to 2s have gotten squeezed a little bit in the last month.
Yeah, we have seen a little bit of a flatter yield curve, Oliver. And I think that the yield curve is really telling two different stories, or two stories, I should say. Maybe they're not different. On the short end of the yield curve, it's that the Fed is going to have to keep interest rates at an elevated level for an extended period of time. So maybe they won't have to cut as fast or as much as expected. We also potentially heard that from Chairman Powell this morning, to where he mentioned that the terminal rate is likely higher than we have seen in the past. That's something that we've discussed, so it's also something that we've heard from him before. So he just reiterated that point. I don't think we really heard anything new out of the Fed this morning. It was just kind of a reiteration of a lot of other things. Now, if you look at the long end of the yield curve, I think that that's telling a little bit of a growth story. Part of the reason why I think that yields have moved lower over the past month, even though they have moved up recently, is concerns over tariff policy, concerns over trade policy, and potentially that could be a headwind to growth.
Okay. Liz Ann, like that on bonds. Let's come back to stocks here for a moment, because the other thing that's happening is some breakage within our very reliable Mag 7 trade. It's slowed its roll quite a bit the last several weeks. What's the solution then for investors, for those who are just kind of like blindly kind of riding the market cap momentum? What's the factor? What's the style that we should have our portfolios geared to instead of those mags?
Yeah, there's certainly a lot more dispersion. You've got 4 of the Magnificent 7 are down in the, 330 to almost 500 in terms of ranking of year-to-date performance. Meta is the only one in kind of the top 10. It is a reminder of the risk associated with concentration. And as you know, Oliver, we've talked about it on this program. I think that individual investors shouldn't feel compelled to have a similar size and concentration in their portfolio to names like that, because they're not benchmarked against the cap-weighted indexes in an official way on a quarterly basis. That's an institutional problem, not an individual investor problem. And the turnaround in many of those stocks is a reminder of that. To your question about factors, obviously we have been very factor focused. And I think the collection of factors that make sense in this kind of backdrop, especially given deteriorating earnings estimates for calendar year 2025. Still double-digit growth, but it's been coming down a few percentage points over the last month or so, is to look for where there is still strong positive earnings revisions. Also bring that valuation and balance sheet component in, where you look for strong free cash flow, positives in terms of interest coverage, high interest coverage. And then maybe another kicker in this kind of environment would be that low volatility factor, so you don't get whipsawed. There are a lot of opportunities. There's a lot of breadth in the market. Only tech is underperforming in terms of negative performance this year. I just think staying in the quality realm from a factor perspective makes sense.
The low vol side of that, Liz Ann, I do wonder, to kind of overlap with some of the bond conversation, how much does that low vol factor right now overlap with income or kind of bond alternatives? Does any of that look appealing if there's potential volatility in bonds coming back?
Well, dividend yield has been a poorly performing factor, and so that you need to be mindful of that. I think that the high interest coverage allows some protection against, to Cooper's point, the possibility of a further move up in, say, the 10-year yield. So avoiding those zombie companies, avoiding the low interest coverage names, as you experience volatility in yields, you have a little bit of protection within, from a factor perspective, in terms of what equities are going to do.
Okay, fantastic. Thank you very much, team.